Good day, fellow investors! One of the videos last year you loved the most was my lithium video. And as I told you then, the ugliness in the lithium sector might continue, therefore don't invest. That is exactly what happened, and over the last year the lithium index is down 43%, down 66 from the peak as lithium prices fell and went even lower, thus there is no rebound. So in this video I want to discuss a standard lithium sector overview as we did in the past. So we have supply and demand, price outlook, and then go through the businesses to see what's going on to understand the risk and reward of investing in lithium. Just to tell you immediately, some of the producers are cutting investments, are putting mines on care and maintenance, which means the supply should go down. Demand is still growing, especially from China. That means that we might be closer to the lithium bottom. I did this analysis of how much supply will hit the market, and now things are even lower because they have cut investments, they have cut growth a lot, which means that there could be, let's say, less supply, and this that was the plan for 2027 might not be. However, we have to also look at the demand side. When you look at the long term, let's say supply and demand, producers are always exuberant, so if you push it back from the exuberance of producers, you get to that 10,000 per ton lithium prices where we are close to now. So we are, let's say, now at the market equilibrium, and we'll see how it goes. When we looked in the past, everyone was expecting 5x growth in demand on lithium, everything was booming. However, if we look at the current projections, this is from Albemarle 2023 chart, this is now 2024, we see that European EV sales are flat, North America is not growing as much, China is booming, but that is just China, and I think that the lithium market misses the growth here that has not happened as expected. When it comes to lithium market drivers, there is growth, everyone is expecting that we will continue on the electrification path. Yes, that is likely the case, but when you look at market reports, this is from Goldman, you see that declines in batteries are expected to go on further. So with lower prices, with lower lithium prices, with more supply, perhaps the balance is not where it was expected to be in 2022, but maybe a little bit lower. And there are two factors why prices are going lower, and perhaps the most important, not supply and demand, but technological innovation. Now, we are seeing multiple new battery products that have been launched that feature about 30% higher energy density and lower cost. When you hear 30%, that is also removing 30% of the demand there, because you can do better with the same or less lithium. And there was a lot of green inflation 2020-2023. The level of those metals was very high, and we are looking for lower for longer commodity costs. And also, solid state is not in the mix yet, but if there are technological improvements that can increase longer term, all those projections are always linear, so we have to see if there will be some new projections that then change the cash cost long term. This is 2023, but maybe there will be less, so you are at 6,000–7,000 from the current 10,000. If we look at supply balances, even adjusted for the cuts, we are still in oversupply for the next few years, even 40–50% of demand going forward, according to Goldman. With supply being much higher than demand, that means lower prices. That's a given. Some are already cutting supply, like the Chinese producers. However, Goldman says that they do not view the product cut along with a few recently announced ones that would reverse the negative outlook of the global lithium supply and demand balance. However, prices are down, there are cuts, and I would say now is the time to watch lithium prices and see what kind of risk and reward do you like to take in your portfolio. Everyone was asking me about lithium 2-3 years ago when the stocks are booming. That's not the time to look at commodities. Now when things are ugly, now is the time to look at commodities. And if I look at the sustaining cost curve for 2028, just a small removal in demand on technological improvements brings you down to 6,000-7,000, which is another 30% down from where we are now. And you can see here the steepness of the cost curve for spodumene, I think here. So there is still a risk, especially from that technological improvement that we have already discussed. And long-term lithium deficits, that was on everyone's mouth in the past. As I always tell you, this was the same story with copper 10 years ago, and we have not seen a supply gap yet. So prices also for Goldman here was always expected to be lower. We are lower, they were correct, and likely they might be correct in the future. Let's go to lithium producers. Let's go through the top positions of the lithium producer ETF, and let's immediately start with Arcadium Lithium. Now we have a Rio Tinto overtake, maybe, I think it's 580, so if that happens in the next year, here is a 15% takeover chance from Rio Tinto. And here we come to a delicate situation, but that is also something that happens with mining. The management wants to cash out, loses patience, wants to get their bonuses, wants to get money. They sell at the price that is much lower than most of the small shareholders invested their money in. They then discuss how it's best for the company, it's best for management to get their assets saved from Rio Tinto's money. They are there for the salaries, not for you making money, plus they will get some bonuses likely from the takeover. The key thing is that Livent was 17, 2.5 Arcadium shares that you got for that. That is, the takeover is now around, I don't know what, $13 per share. The price was much lower before the merger. So those long-term investors in lithium feel like they have been defrauded because of the low Rio Tinto price. And they are suing Arcadium over that promise. And as I said, the stock price is much lower. Maybe if Rio Tinto does get over the lawsuits, we are at 5.8, that's 15%, but it likely take time, and that's why there is a delay. Plus, if it doesn't happen, you are holding Arcadium at 3. So there is a 40-50% loss on that merger arbitrage. I've looked a little bit at Arcadium. Rio Tinto is paying a few billion for what they expect 1 billion in EBITDA 2028, that's 20%. Rio Tinto has the money to develop, can wait. And if I look at the company now, I'm looking at the management. So the CEO has been there for 7 years, time to cash out. On one side, they are right because they are eliminating the risk, and on one side, they are eliminating also the upside potential on another lithium boom. So you cannot predict, you cannot hold them, say this is wrong, because maybe without the Rio Tinto acquisition it goes to zero on the developments, because they need to develop a lot of things, they need a lot of money, they need to take debt to grow according to projects. And if lithium prices are lower, then this is the best value creation at this moment in time for shareholders. So it is hard to just sue them because it is about something that will be unpredictable in the future. However, yes, if you paid more as a long-term investment, now you have to buy something else if Rio Tinto takes you over. And everyone is projecting this long-term growth in demand with limited supply, perhaps just a little bit of technological change here, 30% improvement in technology, and we are at a balanced market. The company has a lot of projects, a lot of doing. I'm looking at all that operational costs, and you can see here how we always get to around 7,000, 8,000 price per lithium. That's why all these projects that are there are still leading to a lower lithium price going forward. Yes, there might be a boom and then you can 2x, 3x your investment, but we'll see about that. For now, EPS is, let's say, 1-0, but nobody makes any money in the lithium situation. I've looked a little bit at the balance sheet and the cash flows, and the cash flows are negative for 2024, which means, given the investments, given what's going on, a little bit maybe on taxes, but I am rounding it up at 0 for the lithium producers that are there, and on top of it, they are still investing a lot of money into capital expenditures. If I look at the balance sheet, now I don't know how they accounted here. Suddenly they have 7 billion in property, plant and equipment. I don't buy that. That is just takeover accounting where they say what they think the lithium in the ground is worth. That's likely Australian accounting. The truth is nobody makes any money, and when you make no money, it's very hard to value something. On the other hand, this is also the opportunity. When these businesses go from 0 to start making money again, and sooner or later over the cycle that will happen, you have a 5x. That is the lithium boom that might happen. Now let's go to the next one. Albemarle, they cut the dividend, but you can see here the boom and the bust. But maybe when you think about these things, if you just look at the trend, then the trend is there, and these are bubbles, and as I always tell you, bubbles usually burst, and that will likely always happen with everyone. Let's look at the investor presentation. Mostly focused on lithium, no matter how you call it. They are now focusing on reducing capex, improving cost of efficiency, unlike last year when they were all about growth. So they have really removed $500 million of capital expenditures, even 1 billion of capital expenditures, to limit the growth, to limit the supply into a declining market. However, there is that, and whenever there is that, you know that there are issues. And then I looked at how they solve issues, and this is the risk when it comes to investing in non-profitable commodity businesses. They need money, and they need to find that money in a way so that they give sweeteners for those that give them money. So this is 3-4 years of 7% plus then 7 to 8 stocks on that preferred share that they have issued a lot and diluted you in the process if you are a shareholder. So those are the risks, and those risks are happening. They have bromine, okay, Dead Sea, that's just part of the question. Now, I have looked a little bit at Albemarle as I thought, okay, convertible, I can buy the convertible, get 7%, and then get all the upside from the convertible. But I've read a little bit, and the thing is that you can get a conversion, and yes, if prices are higher, you get the upside there. But then there is also the risk, so they sweetened it. However, if lithium prices and the stock price is lower, I'm not protected like Buffett buying preferreds. He's protected with cash on the downside. You are not protected on the downside because the maximum you can get is 0.45 of common preferred shares per stock. So when it comes to there, yes, I am exposed to the upside some way, but also exposed to the downside with the 7% preferred sweetener. So the downside is something I don't like, but they managed to get that from the market, which is okay. Now, when it comes to business, they have lowered their growth, but they still have a lot of potential capacity, and if prices go up, they will simply push it higher. This is 2023. They can triple lithium conversion capacity, and it takes a year, 2 years for that to happen. And they expected a lot of growth, and that has already changed. But even with the target there, with the 2000 margin on average, they get to 400 million in profits. And if I compare that to the market cap, 400 million or 600 million, not really something that you would say cheap. Commodities, you buy them at 20% free cash flow over the cycle if you want them cheap. So even lithium companies are not as cheap as I would expect. Let's look at SQM, so Sociedad Química de Chile. The problem here is it is a good business. It has, of course, the ups and downs, the standard ones in a cyclical, especially as it is more diversified. It was fertilizers, now it's more lithium. Then depending on how prices go up and down, it's more fertilizers. So it is a stable company, has always been doing good, great. However, when it comes to lithium, there is one issue, and that is that as they started to make money, then the government came in and took half of their Chilean business plus the taxes there. And on top of the 20-30, 50% loss as the government comes in on their concession, they also included that when lithium prices go higher than 12,000, you pay just 40% of taxes compared to lower if lithium prices are okay. So they are skimming the upside there. When it comes to Chile, the situation there with commodities politics is a little bit tricky, so expect higher taxation, and therefore when you know that somebody is taking so much from you and don't know what will take it forward, the negotiation now is that SQM's lithium business will be owned 50% by the government going on from 2030. So, okay, they can then mine to 2060 on that agreement, but will be mostly owned by the government. And in the normal world, that is called nationalization. That is also priced in here and not something that I want to meddle with over the long term. Too much political risk there to look into. Pilbara. Last time when we discussed, the price was still relatively higher compared to others, but maybe Australians didn't want to believe that lithium prices will go lower. The company keeps doing as they have been doing. However, as spodumene prices fell, eventually the stock fell. When it comes to lithium, we must understand that there is plenty of lithium in the Earth's crust. It's not like copper that is more and more difficult to mine. There is plenty of lithium, and depending on the incentive to mine it, people can mine it. And there is also lepidolite that can be mined and is mined in China. So that is also a competition, and these lithium supply situations come into the market and really make it difficult for us to invest. They are investing into a new mine. The pre-feasibility highlights discuss 55% return on cash flows. However, I looked at the current returns. At these costs, they are not making much money as all other Australian counterparts too. Yes, they are investing, commissioning, but if I look at the guidance and how much they need to still spend and what is the price of spodumene and how they might reach it, when I look at things, okay, great project, but in what kind of lithium environment? That is the question. Yes, long-term prices are 1,500, then there is great value in the project, and the net present value is 2.6 billion Australian dollars or 2 billion US dollars. This is always what you have to look when you look at commodities. You need to look at the sensitivities related to price. The price now of what they are selling is 800. So if I continue like that, then the net present value of their project at lower prices is this. That's commodities, and especially lithium is a very, very volatile commodity. So guidance going forward, it always will depend on the price. Look at this, how much cash they have spent, lowered debt, paid some dividends, invested hugely in the development there, that we don't know yet whether the value will be 0 or 2 billion, maybe 4 billion if prices go higher. But for a cash flow, look like everyone else, they are making now 0. When you calculate off the taxes paid, sustainable capital, I get to a 0 at current prices. And that is also eventually has been reflected in the stock price. Market cap is already 6 billion, and if you add the net present value of 2.5 billion for the project and everything, it's not like it is that spectacularly valued. If you look at the trend, this bubble, if things continue to go down, might continue to reverse, as it is the case for mineral resources going down severely. And now we can also add a little bit of iron to the lithium story. They have Western Australia commodities, iron ore, lithium, and they are investing a lot into their iron ore project, Onslow project, that should be ramped up as we speak. And look at the sensitivity here for iron ore. EBITDA sensitivity at iron ore 100, which is the price now. However, they put it just to 90 to 110. In my calculation, we will see iron ore at 60 in the coming years. So you are taking a lot of debt to build something in a very, very uncertain situation, and you don't know whether it will be 60, unlikely 150. So I'm watching iron ore, and no worries, their cash costs will be 30, but EBITDA might be 600 million just to cover the sustainability. Now, no worries for Amy Terrell here. She will have business, she will have her job, she can keep on smiling, but I don't know whether mineral resources shareholders will be that happy, because at this moment in time profits are not what they used to be, and with debts, with everything, with a lot of capital employed, with still a lot of capital expenditure going forward, with lower prices as they are expected in the next years, I always say, wake me up when iron hits 60, 50, if there is a recession, a glut, whatever, can see. We have to wait a few years for that, but everything looks good there on the cash cost curve. But if we remove this little bit of demand, iron ore prices are at 60, and that is what will likely possibly happen. When this happens, then I'm looking into it. I don't mind waiting a few years to get a commodity buying opportunity, because I really want to buy it at low or no risk with high upside. Now we are at high risk with minimum upside. Here, when it is trading at 75% cash costs, 50, it will trade again at 50. Maybe it will happen just once in the next decade. Then is when I will strike. And you can follow that on my research platform over the years, and also on other commodities. They have also lithium, okay, but again, the costs, when you add the sustaining capital and everything, we are there as everyone else. They made some bad acquisitions. Now they paid, what, 260 million, and now they put on care and maintenance because it is not profitable. So that is normal in the commodities. They paid 260 million for it. So okay, when things are good, everyone is talking about growth and everything. When things are bad, unfortunately, it reverts. And when it comes to commodities, the essence is scarcity leads to a glut leads to scarcity. We are somewhere, we have in the boom, and we are now seeing in the bust, but I think we are still somewhere not far. Everything can happen. These things are very hard to predict, but I'm still watching for that low or no risk entry point for higher potential upside. Now, Sigma Lithium, They were promising so many great things. Now they have on top of everything the Brazil issue that we'll have to see how it goes. But again, the rock prices, the production prices are still there. If I look a little bit at things, they are going to grow production, investing, they also have funded that, but they are all leading into that capacity, into a price that is okay. You are not going bankrupt, but you are not making much money either. Just to look at that, they say they are cheaper than the market, but 2023, depending on how they compare it, it's likely the market will come to their valuation than the other way around. They do have a lot of these currency issues, currency that skews their profitability, then they correct it. So they have some gross profits on the revenue, not bad, but still, when you account for the investments and everything, looks okay, but not good enough, especially when you compare it to the profitability. Okay, 240 million on a 2 billion market cap, okay, but still not great in a great environment. Liontown resources booming and busting as these projects go. You can have whatever vision you want to have, but the key is that you have invested a lot of money into now a negative part of the cycle, and the market then punishes you because you will not make any money at these prices and at these operating costs. That's simply the truth there. The conclusion on lithium, this is my biggest concern and one to watch. The technology improvements, a lot of supply is off the table, which is a positive, which means it could start to be interesting, but pain is also very possible. So you have to understand how much risk you can take for the lithium play there. Now, when it comes to lithium, we don't know yet at what the price balance will be. There is plenty of lithium and the big players are not even playing big. Commodity investing for me is I want to make money always, so I want to make one now when things are bad. That can be, I don't know, 2.5% dividend yield. Thus, we have a competitive advantage that we know we can survive whatever market. I haven't found such a lithium producer, and then when things improve, I make 3. And I'm happy with a 2-3x. That is the value investing perspective for me. Now I am looking at the possibility of losing money, thus I can make 0 with all these lithium producers. We have seen dilution, preferred shares, things like that. Or if things improve fast, I can make 5x. But that's not the kind of game I like playing. For commodities watching over time, please check my research platform, and when the time comes, we will strike.